Good morning and welcome to the Killik & Co market update. It's been a week of interest rate rises and technology results, so let's start by having a look at interest rate rises. We've had rises from the Bank of England, the European Central Bank and the Federal Reserve. The Bank of England put rates up by 50 basis points or 0.5%, taking our rate to 4%, which is the highest level since 2008. The ECB put rates up by 50 basis points, which takes its deposit rate to 2.5%, and the Federal Reserve put rates up by only 25 basis points to a range of 4.5 to 4.75%. This smaller rate rise from the US had been expected, and markets had been moving higher ahead of this week's decision in anticipation that the pace of rate rises would start to slow down. So let's take a look at the performance of the S&P 500 and the Nasdaq Composite this January compared to last year's January. Last January, when inflation and rate rise expectations were really starting to ramp up, the S&P dropped 5.3% and the tech-heavy Nasdaq Composite dropped by 9%. This January, we've almost got the opposite, with the S&P up 6.2% and the Nasdaq up by 10.7%. Although markets had been moving higher in the run-up to that rate decision from the US, markets still reacted very positively on the trading day following that rate rise announcement, especially the technology sector. Apple, Alphabet and Amazon were up by 3.7%, 7.3% and 7.4%, and that's the first number in each of these three boxes. All three of these companies then reported their results after hours, and we saw all of the shares declining in after-hours trading. Apple was down by 3.2%, Alphabet down by 4.6%, and Amazon down by 5.1%. Apple's phone sales were lower than expected, and the company also talked about supply chain problems coming out of its Chinese business. Alphabet said its quarterly revenues grew by just 1% in the quarter, although the company did still make revenue of $76 billion. And then finally, Amazon said that the growth rate in its cloud business had slowed down a bit, but it did still achieve a growth rate of 20% for the quarter. And finally, Meta is worth a look, given that the shares rose by 23% following the latest set of results. Here's the 5-year chart for Meta. You can see the shares are still well below where they were in 2021, but the share price has more than doubled since hitting a low last October. Investors have been concerned about how much the company intends to spend on the metaverse, but this week the company reduced its planned expenses for this year by $5 billion, and the company also announced plans to buy back $40 billion worth of its own shares, which should help to support the share price. A key metric for Meta is the number of active users across its family of platforms, including Facebook, Instagram, and WhatsApp. And you can see this metric has continued to increase, coming in at 2.96 billion for the final quarter, which is a pretty impressive number given the size of the global population. Moving on to have a look at next week, we are expecting results out from BP, Disney, and PayPal. That's it from us. Enjoy the weekend, and we'll see you next Friday.